We're looking at Borusan Boru Fabrik Malaria Sanayi Vetikert Aishin. You know them, and their 9-month 2025 consolidated financials and activity report.
Yeah, and this isn't just some dry accounting document. It's packed with clues, really. Clues about how a huge global player in steel pipes is handling, well, a pretty volatile world. Think high Turkish inflation, currency risks, complex U.S. trade stuff, geopolitical tensions.
Yeah.
It's all in there.
Exactly. So our job today, our mission, if you like, is to take this dense pile of corporate data, TL figures, USD figures, UR figures, all mixed up, and turn it into something sharp. Actionable knowledge for you, the listener. We need to cut through that complexity, figure out where Borusan is actually winning, where the challenges are popping up, and really what their strategy means going forward.
Mm-hmm. And we'll be comparing mainly this 9M 2025 period against the same 9 months in 2024, and also looking back at the full 2024 year-end results.
Yeah.
That gives us the context. This is basically your shortcut to understanding Borusan's health, its direction.
Yeah.
We've built this specifically for the individual investor looking at this space.
Okay, perfect. So grab that coffee, settle in. Let's get started on this massive deep dive. And hey, if you know anyone interested in this stuff, cross-continental manufacturing, steel sector investments, maybe share this with them. Could be useful. Subscribing doesn't hurt either for future deep dives. Okay, first things first. Let's unpack who Borusan Boru actually is. I mean, this company is a real heavyweight and industrial titan, founded way, way back in 1958. Yeah, long history.
And their core business is fundamental infrastructure stuff. Longitudinal welded and spiral welded steel pipes. Essential components. Their official HQ, the legal address, is Ataşehir in Istanbul, and they've been listed on the Borsa Istanbul since 1994, so quite established in the public markets too.
But they're not just a Turkish company, are they? Their identity feels much more global now.
Oh, absolutely. Fundamentally, Borusan operates like a multinational. They're spread across 3 continents, got 10 different facilities, and the scale is just staggering. We're talking 1.75 million tons of total production capacity. That's spread over 1 million square meters of land. And get this, over 4,000 different product types. That sheer breadth, that diversification, is probably their biggest shield against, local economic bumps.
And it's not just about exporting, right? They're actually producing locally in key markets. Tell us a bit about those global subsidiaries.
Right. So the Turkish base is still significant. GemlikConclusionBorusan Boru, that's about 800,000 tons capacity, employs over 1,200 people. Still core. But strategically, a lot of weight now seems to be shifting to 2 other regions. First, the U.S. You got Borusan Pipe U.S., and then those Berg Pipe facilities. They acquired one in Mobile, Alabama, one in Panama City, Florida. These are really positioned as key local players now, especially for high-value stuff like OCTG.
OCTG, oil country tubular goods, for the energy sector.
Exactly. And also those big, large diameter pipes for infrastructure projects. Being local there is huge. Then secondly, there's Europe. They've got a presence in the Netherlands, Germany, Spain, Romania. But the one to really watch is the Volbarno facility in Italy.
Why Volbarno specifically?
It's specialized,
Yeah.
highly specialized, actually. It focuses only on these high-value, cold-drawn special tubes, about 30,000 tons capacity. These aren't your standard pipes. They're high-spec components, mainly for the European automotive industry. Think German and Italian car manufacturers. So again, it's about localizing production, putting that high-end stuff right near the demanding customers.
Okay, so Borusan is actively playing defense, embedding themselves in the economies they serve, managing risk that way, which naturally brings us to the bigger picture, the economic headwinds and tailwinds they're sailing through. #tab B, sectoral headwinds and tailwinds, macro and SWOT analysis.
Yeah, and the global backdrop is, well, it's tricky. You read the IMF reports, listen to the central banks. It's all about rising protectionism, geopolitical friction, lots of uncertainty. Definitely not smooth sailing for a company doing business across continents.
But their biggest market, the U.S., seems like maybe a slightly brighter spot, or at least less gloomy.
It's complex, yeah. The Fed's analysis points to consumer spending slowing down a bit, the labor market cooling off. But interestingly, they actually nudged the 2025 growth estimate up slightly to 1.7%. But the real signal, I think, for the markets anyway, was that rate cut in September, just 25 basis points, but still...
Shift instance.
Exactly. A move towards maybe a more neutral position.
Yeah.
Suggests they think they're getting inflation under control, or at least balanced against employment risks now.
And Europe, the Eurozone.
The forecast there is for gradual strengthening. About 1.2% growth projected for 2025. What's supposed to drive that is rising wages and, importantly for a company like Borusan, government spending on infrastructure. That could be a tailwind.
Okay, let's zoom in specifically on the steel sector itself. What are the dynamics there?
Well, globally, raw steel production actually dipped slightly in the first 9 months of 2025, down 1.6%. In Turkey, production was kind of flat, just up 0.6% to 28.1 million tons. But here's the kicker. Domestic consumption of steel in Turkey jumped much faster, up 3.9% to 28.9 million tons.
Ah, so demand outstripped local production growth. You mentioned earlier this creates huge pressure locally. How does that work?
It creates a really tough environment for Turkish producers, Borusan's home facilities included. Look at the capacity utilization rate for the Turkish steel sector. It's running low, only about 63%. And why? Because a massive chunk of the steel being consumed is imported. Imports make up something like 48% of total consumption inputs.
48%. So nearly half the steel used is coming from abroad.
Exactly. Turkish producers are basically struggling to compete on their home turf against cheaper imports, often heavily subsidized, sometimes just dumped.
Right. So facing that reality
Right.
is pretty much explains Borusan's whole global strategy, doesn't it?
It really does. It boils down to two main defensive plays. First, they spread the risk, diversifying across those four main business lines: infrastructure, industry construction, OCTG energy, and automotive. If one area is weak, maybe another is strong. Second, and this is absolutely critical for them, they lean heavily on exports and that local production abroad we talked about. An incredible 84% of their total sales revenue comes from international markets.
84%.
Yeah, it's huge. And it's not just because they want to export, it feels like an absolute necessity. It's how they shield the overall company from the volatility and, frankly, the overcapacity problems plaguing the Turkish domestic market.
Okay, so we've got the global footprint, the market context. Now let's look inside. Who's actually running the show? Let's start with ownership and any recent changes there. Hashtag AA, ownership structure, and key changes.
Right. The big structural event this year was definitely that merger with B&B Holding A. That finalized back in early January 2025. Essentially, it was a big internal tidy-up. The main Borusan Boru company basically absorbed all the assets and liabilities of B&B Holding.
So more housekeeping than a radical shift? Did it change the capital much?
Not really on the capital front. Just a tiny technical increase from 141,750,000 lira up to 141,772,000, hardly noticeable. What it did do is streamline the ownership structure, makes things clearer operationally. Post-merger, control stays firmly where it was within the Borusan Group. Borusan Holding itself has 64.40%, and Borusan Yatırım ve Pazarlama holds another 9.08%.
And for investors like us, the publicly traded part.
Good news there. The public float, the shares actually trading on the market, stayed exactly the same at 26.52%. So the merger didn't dilute the public shareholders.
Okay. Now, you mentioned control. There's a specific mechanism they use for that, a share structure that's important for investors to grasp.
Crucial, yeah. It's a dual-class share structure. You've got A group shares and B group shares. The A group shares are actually only 10% of the total number of shares. But, and this is the key, they carry 5 votes per share. Plus, the holders of these A shares get to pick half the board of directors.
Ah, so disproportionate voting power.
Exactly. The other 90% of the shares are the B group ones. What this setup does is ensure that even though the company is public, the core strategic direction, the real control, stays tightly held by the main Borusan entities. It's basically unchallengeable by smaller public shareholders. Hashtag B management and gender diversity.
All right, let's look at the people making the decisions, the board of directors. How's that structured?
It's a 7-member board, and the report notes that 3 of those 7 are designated as independent members.
And diversity, specifically gender diversity on the board.
Well, the numbers tell a pretty clear story there. There's definitely room for improvement. Out of the 7 board members, only 1 is female. That's Defne Kokobjoknarter, and she serves in a non-executive role. So that works out to about, 14.3% female representation on the board?
Okay. And what about the executive committee, the team running the day-to-day operations?
That committee has 10 members. And again, similar picture. 1 female executive out of the 10, that's Nihan Alhen, who holds the role covering human resources and sustainability. So 10% representation there.
Okay. Let's shift to personnel overall. Did we see big changes in staffing levels, maybe linked to the merger or this efficiency focus we've touched on?
A slight decrease, yeah.
Yeah.
Consistent with maybe tightening things up. Total headcount went from 2,421 people at the end of 2024 down marginally to 2,328 by September 2025. And the structure, it's still heavily weighted towards the operational side, the shop floor. You've got 500, 804 blue-collar workers compared to 524 white-collar staff.
Okay, now this next point really jumped out at me from the report, it seems. Well, quite significant. Executive compensation. How did pay for the top brass change compared to last year?
Yeah, this is genuinely striking. The total compensation, remuneration, benefits, the whole package paid out to upper management, which means the board and the executive committee combined. For the first 9 months of 2025, it was 66,969,000 Turkish lira.
Okay, and compared to the year before?
That's where it gets dramatic. In the same period in 2024, the figure was 113,624,000 lira.
Wait a minute. That's a massive drop. Roughly 41% less paid out to top management.
That's right. A very sharp reduction.
A 41% pay cut for the leadership team while they're managing a huge merger integration, trying to boost margins. That doesn't sound like just trimming expenses. Does the report say why? Performance targets missed? Or was it a deliberate signal?
The report doesn't explicitly state the why, so we have to infer a bit. But the timing is suggestive, isn't it?
Yeah.
It happens right after the merger beds in and just before they announce this massive efficiency project in Gemlik we'll get to. It could signal an incredibly strong focus on cutting overheads, maybe aligning executive pay much more tightly with bottom-line profitability, not just, say, revenue growth. It certainly sends a powerful message internally about cost discipline starting right at the very top.
Right, that kind of top-level discipline usually flows down. So let's see how it translated to the actual business segments. How did BRSN's 4 main divisions perform in the first 9 months of 2025? We should probably use the US dollar figures for a clear comparison, given the Lira volatility. #A. Operational performance by business segment. 9M 2025 versus 9M 2024 USD basis.
Okay, yeah, using USD makes sense. The overall story operationally is really about a successful strategic shift. Primarily capitalizing on opportunities in the U.S. market.
Let's start with infrastructure and projects. That's usually their biggest slice, right? About 41% of revenue here.
Correct. This segment actually saw its revenue drop, down 18.0% to $541.9 million. Volume was also down about 11.0%. Now, management's explanation for this was what they call the high base effect.
Meaning last year was unusually high.
Exactly. They apparently completed some exceptionally large projects back in 2024, which makes the 2025 comparison look weaker than the underlying business might be. They did mention that deliveries for ongoing major contracts, like the Blackcomb Mainline project, are still happening. So the project engine is still running, just maybe not at that peak 2024 speed.
Okay. Next up, industry and construction. That's about 25% of revenue, and this one looked like the standout performer.
Oh, absolutely. The turnaround here was pretty remarkable. Volume just surged up 36.6%, and revenue followed, jumping 45.5% to $325.1 million. And this wasn't just market luck. This was a direct result of strategy, specifically that new SRM factory in the U.S.
Ah, the one that came online late last year?
Yeah, fully operational in Q3 2024. And it immediately allowed BRSN to start making certain products locally in the U.S., products that before the market mostly had to import. So they basically leveraged the U.S. trade environment, maybe some protectionism, to grab significant market share almost overnight with local production. A clear win from that investment.
Perfect example of CapEx paying off quickly. Okay, moving to OCTG Energy. That's 23% of revenue.
This segment was more stable. Volume ticked up slightly, 2.6%. Revenue also up just a little, 1.4%, reaching $303.1 million. The positive here was a pricing environment. Management specifically cited uncertainty around tariffs on imported OCTG products in the U.S.
So uncertainty for importers is good news for the local producer.
Pretty much. It creates a bit of scarcity, maybe perceived scarcity, and allows local guys like BRSN to charge more. But there's a significant but here. Management was very clear in their guidance. They expect this favorable pricing situation to normalize, basically cool off, in the fourth quarter of 2025. So enjoy while it lasts.
Got it. A temporary boost, perhaps. And finally, the smallest segment, automotive. 11% of revenue. This one seemed to struggle.
Yeah, this faced the toughest conditions. Volume slipped 2.9% and revenue fell 6.0% to $147.0 million. The report pins this directly on weak demand in the European pipe market, plus intense price competition over there. This segment is really important for that high-value Vobarno plant in Italy we talked about. It's clearly feeling the pinch from the economic slowdown, hitting places like Germany and Italy. #B. Strategic investments in future projects.
Okay, so a mixed bag operationally, but clearly BRSAN isn't just sitting back. They're investing. Total capex for the 9 months was 1.4 billion lira, just under last year's number, but highly focused, it sounds. Let's talk about the big projects. First, that JCO technology investment in the U.S. This sounds like a major strategic move.
Oh, it absolutely is. This is a $68 million investment, given the green light back in December 2024. They're spending that cash over 2025 and 2026. It's happening at their Panama City facility in Florida. JCO is a specific tech for making straight seam steel pipes, but here's why it's such a potential game changer. The goal is to make Borusan the only local producer of these specific pipes in a U.S. market segment they estimate is worth about 150,000 tons a year, a segment currently served entirely by imports.
Wait, hang on. Not just competing better, but becoming the sole domestic supplier for that product type.
That's the plan. It's pure strategic positioning. If they pull it off, they basically insulate themselves from global competition within that niche, protected by U.S. import conditions. It's a massive potential boost for their competitive advantage and, crucially, their long-term margin stability in North America, expected to be operational in 2027.
Wow, okay, that's ambitious. Now, domestically, back in Turkey, they're tackling that efficiency issue we discussed earlier, the Gemlik consolidation project.
Yes, this is a huge internal reshuffle. They're basically closing down their operations in Halkalı and Bursa and moving everything, production lines, people, the lot, to their main Gemlik campus. The idea is to create one single, super integrated, highly efficient strategic hub in Turkey. But it's costly. We're talking $29 million in capital expenditure for the new setup, plus another big chunk, $27 million in one-off cash costs just for the move itself. Relocation, logistics, potential downtime.
$27 million just to move stuff. That sounds incredibly complex. Moving entire factories without disrupting production too much. What's the payoff they're expecting? Why take on that headache?
They're forecasting two main benefits, which they expect to see fully realized within about 24 months. First, they're targeting around $30 million in working capital improvement. Better inventory flow, streamlined logistics, maybe faster receivables from having everything in one place. Second, and perhaps more important for the bottom line, they expect this consolidation to add between 50 and 100 basis points. That's 0.5 to 1.0% to their consolidated EBITDA margin.
So a direct hit on profitability.
Exactly. This project is their big answer to those domestic challenges, the low capacity use, the tough import competition. They're trying to squeeze every last bit of efficiency out of their Turkish base to make it more resilient. #C. Management outlook and guidance update.
Okay, so given this mixed strong U.S. performance, offsetting some weakness elsewhere, plus these big strategic bets, did management update their outlook for the full year 2025?
They did, yeah. A slight upward revision, but a meaningful one.
Yeah.
And they explicitly linked it to the positive performance, especially in the U.S. So for sales volume, they originally guided for 1.05 to 1.20 million tons. They've now raised and tightened that range to 1.20 to 1.35 million tons.
Okay, selling more tons. What about the money side, revenue and profit margins?
Sales revenue guidance also got a bump, up from $1.8 billion to a new range of $1.7, $1.9 billion. And reflecting that cost control and the U.S. success, the crucial EBITDA margin guidance was lifted too. It was 5%, 7%. Now they're guiding for 6%, 8%.
So more confidence overall driven by the U.S.
Seems that way. It suggests the operational improvements are real and are helping them navigate the generally tough global pricing environment.
But if so much hinges on the U.S. market continuing to perform well, especially with those potentially temporary high prices, doesn't that make them quite vulnerable? What risks did management themselves highlight?
That's the key question, isn't it? And yes, they flagged three main risks very clearly. First, as we mentioned, that explicit warning that the favorable OCTG pricing in the U.S. is likely to normalize to come back down to earth in the fourth quarter. Second, the ever-present risk of changes to U.S. import tariffs. Their whole U.S. strategy benefits hugely from the current tariff landscape. If that changes, it could hurt them. And third, the ongoing internal battle. Rising costs within their Turkish operations, driven by high inflation and the volatile exchange rate, that remains a persistent headache. So, yeah, the strategy looks smart, but it's definitely leaning heavily on things like trade policy staying relatively stable.
Okay, we've covered the strategy, the operations, the big investments. Now let's hit the numbers hard. Did all that effort actually show up on the financial scorecard? Let's dive into the 9M 2025 consolidated results. #A, revenue and profitability deep dive. 9M 2025 versus 9M 2024.
All right, let's start at the top line. Consolidated sales revenue, or CIRO, as it's called in the Turkish reports. On a Turkish lira basis, it looks fantastic. Jumped to 51.25 billion TL, way up from 42.98 billion TL the year before.
but
Big but there. Turkish lira, inflation. We need to filter that, right? Look at the USD equivalent for the real picture.
Absolutely essential. That huge lira increase gets massively distorted by inflation and the exchange rate movements. So when you strip that out and look at it on a US dollar basis, which is their functional currency, the one that really reflects the bulk of their international business, revenue actually dipped slightly, down 1.6%, landing at $1,317.2 million.
Okay, so slightly less revenue in dollar terms, even though they sold more volume. Volume was up 6.7%, you said.
Exactly. And that confirms what we saw in the segment breakdown. Overall price pressure, especially outside that strong US OCTG market and in Europe, must have compressed the average selling price, leading to slightly lower dollar revenue despite higher sales tonnage.
Interesting. But the operating margins, they tell a completely different story, a much stronger one.
They really do. This is where the efficiency focus shines through. Gross profit, in lira terms, jumped nicely to 4.60 billion TL from 3.29 billion. Operating profit, İsas Faaliyet or EBIT, saw a significant increase, up to 2.60 billion TL from 1.94 billion. And the key metric we often focus on, EBITDA, calculated on that stable EBITDA basis, actually increased by 5.6%. It reached $101.4 million.
Wow. So revenue slightly down in dollars, but EBITDA up over 5%. That's significant margin expansion. They must be keeping a really tight lid on costs.
Precisely. The EBITDA margin itself improved by half a percentage point, rising from 7.2% last year to 7.7% this year. That improvement, it's a direct reflection of that cost control discipline we talked about, plus the strategic benefit of shifting some production to higher margin products in the U.S. It helps offset those domestic cost pressures.
Okay, now for the number that almost looks like a typo when you first see it, the bottom line, net profit, dünüm net kavu. It went from $10.5 million profit last year to $38.0 million profit this year. In USD terms, that's almost quadrupling the net profit. Can that huge jump really just be from operational improvements and cost control, or is there something else going on, maybe a big one-off gain hidden somewhere?
That's exactly the right question to ask. And you're right, it's not just operations. The massive leap in net profit was heavily influenced, maybe even primarily driven by something else. Much lower financing costs, total financing expenses, interest payments on debt, related costs, they dropped sharply. They paid 1.62 billion lira in finance costs in 9M 2024. In 9M 2025, that fell to 1.08 billion lira.
Ah, okay. So better operating margins plus significantly cheaper debt. That combination acted like a multiplier on the final profit number. They spent less money to make their money this year.
That's a great way to put it, yes. Successfully cutting the cost of their debt was a critical piece of this net profit recovery story. #BB. Cash flow and working capital performance.
Okay, if the net profit jump was impressive, the change we see in operational cash flow, honestly, this might be the single most important improvement in the whole report, wouldn't you say?
I'd agree. It signals a fundamental shift in how they're managing their day-to-day finances. Operational cash flow went through an absolutely massive swing, almost 7 billion lira difference. In 9M 2024, they actually had a net cash outflow from operations of 1.91 billion lira. They were burning cash operationally. In 9M 2025, a complete reversal. A strong net cash inflow of 4.95 billion lira.
A 7 billion lira swing from burning cash to generating cash operationally. That's huge.
Yeah.
How did they manage that? Is it just the higher profit flowing through?
Profit helps, but a swing that big is almost always down to deliberate improvements in working capital management, WCM. It means they got much tighter, much more disciplined on two key things. Collecting money from customers faster, so reducing their day sales outstanding, or DSO, and also managing how quickly they pay their own suppliers, optimizing D's payables outstanding, DPO. Basically, they got much better at turning sales invoices into actual cash in the bank compared to the year before.
And getting cash in faster is always better than borrowing to fund operations. Okay, so even though inventory shot up, their cash management improved.
Seems so. Inventory stockler did nearly double in lira terms, yeah? Went from 12.4 billion up to 20.3 billion lira. That looks concerning at first glance. But, crucially, the inventory turnover rate actually got better. It improved from 3.15 times last year to 4.0 times this year. So even though they were holding more stock in absolute terms, maybe due to strategic buying, maybe just inflation, they were actually selling through that stock faster relative to their cost of goods sold.
Yeah.
The efficiency drive seems to be working both on the factory floor and in the finance department. ##Shade2. Debt and liquidity ratios.
Right, and all that positive cash flow must have had a great impact on the balance sheet, especially on their debt levels. How's the debt situation looking now?
Looking much healthier. Net financial debt, that's total debt minus cash, fell significantly, down 35.9% compared to the previous year. It settled at $243 million. That's a substantial reduction. And it immediately makes the company feel more stable, gives them more breathing room.
And their ability to actually service that remaining debt, the leverage ratio.
Also improved nicely. The key leverage ratio, net financial debt divided by EBITDA, came down to 2.3x. Getting that ratio down to 2.3 times is pretty good. It means their debt is only 2.3 times their annual operational earnings power. That gives them a lot more financial flexibility, probably better access to cheaper borrowing for those big future investments like that $68 million JCO project in the U.S.
Okay, debt picture improving.
Huh.
But the short-term liquidity ratios, things like the current ratio and quick ratio, they actually dipped slightly. How should we read that?
Yeah, both saw a small decrease. The current ratio, which is current assets divided by current liabilities, slipped to 1.22 from 1.31 at the end of 2024. And the quick ratio, which is similar but excludes inventory from current assets, went down to 0.55 from 0.59. The most likely explanation, as the analysis suggests, is that big jump in inventory we just talked about. Because inventory is taken out of the quick ratio calculation. If your inventory balloons, your quick ratio naturally looks worse, even if the rest of your short-term assets and liabilities are stable or improving. So probably linked to the inventory build. #D, equity structure and change. Those kainak dishimi.
Got it. Okay, last piece of the main financials. Total equity, or its kainak dishimi. How did the company's net worth change over the 9 months? Did that profit recovery give it a big boost?
Equity definitely increased significantly, yeah. It went from 30.1 billion lira at the start of the year up to 37.0 billion lira by the end of September 2025. And there were two main things driving that increase. First, obviously, the net profit for the period, that 1.53 billion lira we discussed, flowed straight into retained earnings.
Okay, that makes sense. What was the second bigger driver? Because 1.5 billion doesn't get you from 30 to 37 billion.
You're right. The much larger contribution came from something slightly less tangible, an accounting effect related to their extensive foreign operations. It's listed under Other Comprehensive Income, and it's called Foreign Currency Translation Differences. Yabanka Parachevrim Farklari. This line item absolutely exploded, jumping from about 12.45 billion lira up to 16.68 billion lira. A huge positive swing.
Okay, foreign currency translation differences. Can you break that down for us? Why does that create such a big gain on paper?
Sure. Think about it this way. BRSAN owns valuable assets overseas, factories, equipment, inventory, primarily valued in strong currencies like the US dollar or the euro. But for their consolidated report, they have to translate the value of everything back into Turkish lira, which has been depreciating significantly against those currencies. So when you take an asset that's held its value or even increased in USD terms and you translate it back into a much weaker lira, the lira equivalent value looks much, much higher than it did before. Accounting rules capture this difference as an unrealized gain in the equity section. It boosts the reported equity number significantly, but it's important to remember it's a translation effect, driven by currency movements, not cash generated from selling products.
Right, that's a really important distinction. Thanks. Okay, we've covered the main financial statements. Now let's dig into the footnotes and some of the critical context around risk management. Starting with related parties, how much business does BRSAN do within the wider Borusan group? #I related party transactions.
The huge amount. Given how integrated BRSAN is within the broader Borusan holding structure, these related party transactions are really extensive. They touch almost everything: logistics, raw materials, energy, finance.
Who are the main group companies they're dealing with?
Well, the ultimate parent, Borusan Holding, obviously. Then key subsidiaries like Borusan Logistic, no logistics arm, Borusan InnoBW Energy, for energy, and also financial investments they hold, like their stake in Borsalik Gelik Sunny Night, ASHI, another steel company.
Okay, let's look at the first 9 months of 2025. What were the big flows? Purchases first.
Total purchases from related parties came in at 823.9 million lira. And the really significant takeaway here is just how reliant they are on the group's logistics company. Borusan Logistic accounted for the lion's share of service purchases, 654.7 million lira. That's huge. Borsalik was also important, supplying 127.3 million lira worth of products or raw materials, plus another 44.9 million in services. Sales to related parties were tiny in comparison, only 2.9 million lira. Although, interestingly, BRSAN did receive 66.9 million lira in dividends, mostly from that investment in Borsalik.
That massive spend with Borusan Logistic really underscores their operational dependency, doesn't it? It's efficient, maybe, having an integrated logistics network, but it also sounds like a potential single point of failure if anything went wrong with logistics operations.
That's a fair point, yeah. The integration offers benefits, but concentration always carries risk. And you see this dependence reflected in the balances owed at the end of the period, too. Borusan had significant commercial payables money they owed to related parties, totaling 123.1 million lira. And again, the biggest chunk of that, 89.5 million, was owed to Borusan Logistic. #B foreign currency and hedging strategy.
Okay. We already touched on currency effects boosting equity, but let's talk about the ongoing risk management. We know their functional currency is USD, but they report in TL, creating constant exposure.
Exactly. And because they operate so heavily in Europe as well, they have two main currency risks relative to their core USD operations. They're exposed to fluctuations in the euro, EUR, and of course the Turkish lira, TL. Given the scale of their international deals and debt, managing this currency risk through hedging isn't just a nice-to-have, it's absolutely essential for financial stability.
Can we quantify that exposure? The report usually gives sensitivity analysis. What happens if the euro moves significantly against the dollar?
Yeah, they provide that. According to their 9M 2025 sensitivity analysis, if the euro were to appreciate by 20% against the US dollar, it would actually hit their profit negatively by a pretty substantial 246.7 million lira.
Okay, so a stronger euro hurts their bottom line when translated back to USD. What about the lira?
It's the opposite effect there, naturally. If the Turkish lira were to appreciate by 20% against the US dollar, which, let's be honest, hasn't been the trend, it would positively impact their profit by 187.6 million lira. So clearly, the euro exposure seems to be the bigger immediate P&L risk they need to actively manage.
And are they actively managing it? What kind of hedging are they doing?
Oh yeah, very actively. The report confirms they use derivative financial instruments, things like forward contracts and cross-currency swaps, specifically to manage this currency risk. They even highlight executing a large 2.4 billion lira cross-currency swap during the first 9 months of 2025. That shows a pretty proactive approach to trying to lock in exchange rates and reduce the uncertainty, especially around their foreign currency-denominated debt. #C, price and credit risk management.
Okay, currency risk is one thing. What about the price of their core commodity steel? Steel prices are notoriously volatile. How exposed are they?
They definitely have price risk. It impacts the value of the raw materials they hold in inventory, and it affects the selling prices they can achieve, particularly for sales outside of those big, long-term infrastructure projects where prices are often fixed up front. Their main mitigation strategies are trying to optimize how long they hold inventory, turn it over faster, which we saw they improved, and being nimble enough to pass on raw material price changes quickly into their own sales prices where possible.
Right. And the final major risk, credit risk. The risk that customers won't pay their bills. How are they managing that?
They use a whole toolkit here. Things like demanding bank guarantees or letters of credit from some customers, using credit insurance, sometimes even taking mortgages as collateral. Standard stuff for a big industrial company. However, there was one data point in the credit risk section that definitely caught my eye. It relates to receivables that are past their due date but haven't yet been written off as bad debt.
What about them?
That number increased quite significantly. Past due, but not impaired, receivables jumped from 293.5 million lira at the end of 2024 up to 568.1 million lira by the end of September 2025.
Whoa, that's nearly doubled in just 9 months. Money owed that's late. Even though their overall cash flow improved, that suggests some of their customers might be feeling financial strain.
It certainly could indicate that, yeah. It's a potential warning sign about the financial health of some parts of their customer base.
Yeah.
The report does try to soften this a bit by noting that a decent chunk of that overdue amount, 230 million lira worth, is covered by collateral, like those guarantees or insurance policies. So the actual risk of loss might be lower than the headline number suggests. But still, the fact that the absolute amount of late payments has risen that much is definitely something to keep an eye on. It reflects the pressures in the wider economy they sell into.
Absolutely. Okay, that feels like a pretty exhaustive run-through of Borusan's 9M 2025 performance and position. We've covered a lot of ground.
We certainly have. And if we had to synthesize it, the key success factors really stand out, don't they? Operationally, they managed to improve margins, getting that EBITDA margin up to 7.7%, largely thanks to the U.S. strategy. And financially, the discipline was exceptional, reducing net debt, cutting finance costs, and achieving that massive positive swing in operational cash flow. Those are huge wins.
Yeah, the strategy seems crystal clear now. Double down on the U.S. market where they have a tariff advantage and can earn higher margins, funding that with big investments like JCO. And at the same time, back home in Turkey, ruthlessly pursue efficiency to make the domestic operations leaner and more cost-effective, through things like the Gemlik consolidation.
And that ability to pull in 84% of their revenue from outside Turkey, that gives them the financial muscle, the ballast, to actually afford these big domestic restructuring efforts and fund that future growth engine in the States.
Okay, so let's wrap up with our final provocative thought for you, the listener, to mull over. Management is pinning big hopes on that Gemlik consolidation project, forecasting a $30 million working capital boost and adding 50 to 100 basis points to the EBITDA margin. The question is, can they actually realize those significant operational gains fast enough? Fast enough to offset the potential hit coming when that favorable U.S. OCTG pricing inevitably normalizes, which management themselves predict will start happening in Q4 2025 and likely continue into 2026.
Yeah, that's the race, isn't it? Can the domestic efficiency gains kick in quickly enough to compensate for the potential fading of that premium pricing power they've enjoyed in their most profitable market? The story of 2026 might hinge entirely on the timing of those two offsetting trends.
An excellent point to end on. It's a balancing act. Okay, take this analysis, dig deeper if you want, the reports are out there,
Yeah.
and definitely share this depth dive with anyone else you think needs to get up to speed on BU-FAR. Thanks so much for joining us today.
My pleasure. Always fascinating to unpack these numbers.